Hey everybody, this is Brant from Wolf on Wall Street Trade with the market update for the week ending April 24th, 2020. This is the S&P 500 down 1.3% on the week, but as you can see, really hanging around this 50-day moving average. The NASDAQ 100 ended up down 0.5% on the week. It did have a really ugly start to the week, Monday, Tuesday. It broke a trend, which I'll show you a little bit closer on intraday chart, but it found support right here Tuesday at its 50-day moving average and bounced the rest of the week down 0.5%. And then we have the Dow, which was down 1.9%. Like small caps, it is below its 50-day moving average over here. On the way down, the market did not respect these moving averages whatsoever or any kind of technical level. People just wanted out. But now that volatility has come down, we're really seeing them hang around these technical levels and moving averages. Here's a 60-minute chart of the S&P 500. This is our crash. This is the March 23rd low with the Fed, all their intervention. This is the counter trend rally or the bounce sense, and this is the last couple of weeks. What you might notice if you take a closer look is that since the 9th, the S&P has been going sideways for about 2 weeks. So here's a closer look. So basically around 2,700 to just below 2,900. I have some trend lines here, as you can see, and basically what I have is a bullish ascending triangle. The fact that the S&P was making higher lows over here and higher highs over here meant price action was bullish. So it fit with this interpretation of a bullish ascending triangle. On this break Tuesday, we make a lower low. And on the bounce through the rest of the week, we make a lower high. And there's definitely been a change in character in the price action, but really until the S&P breaks below 2,700, there's not really a change in trend. Here's the Dow 30, looks the same way. NASDAQ 100 gives a little more color because you have a 2-week uptrend here. That trend is broken on Tuesday. And you can see the same thing in several S&P sectors. Here's consumer staples. Here is a trend break this week. Let me zoom out a little bit. You can see the trend over here, uptrend. Here's the break this week and a little consolidation. This is a little tougher to call a clean break, but this is the technology sector. There's a break on Monday, Tuesday. Zoom in a little bit on that. You can see the break here kind of back testing the rest of the week. And here's semiconductors. So again, not the cleanest trend, but you could definitely see a change in character, a break of that trend. It's the cyclicals that have been weaker. So for example, the material sector, it's a lightly weighted sector, but this is a bearish consolidation, a descending triangle. I give it the benefit of the doubt because it came after an uptrend. It's consolidation after an uptrend, but it is a bearish consolidation. The energy sector was really bullish over here. I called it out in a video a couple weeks ago. Broke out, was looking good, broke this trend and has kind of back tested below this trend since, but it did find support here at 31. Here's the industrial sector, again, like materials, another bearish descending triangle. Same thing for Dow transports. The financial sector, ever since the earnings season started, with the banks kicking off earnings season over here, has not acted well, but technically it's still in a triangle consolidation that follows an uptrend. So technically it is still bullish, but you can see it is underperforming. I think the takeaway is that these cyclical sectors, highly growth sensitive, are going to have to start kicking in and taking up reins of leadership now that we're seeing places like technology break trend. Crude oil just did something historic this week and traded negative for the first time ever. Acted real bad Sunday night, come into Monday overnight session, and then come into the cash session right about here. Now at this point, it's gone from $17.50 down to $8. That's a crash in and of itself. Over here, it's trading down to $4 from $8. It's been halved again. It's trading at $1. And over here, it's trading at 1 penny. It kept on going. This is negative. So you can see zero over here, negative $2, negative $4. It eventually went down to negative $40. The S&P really barely did anything, down 1.3% on the week, considering what happened in crude oil. I know there's that contract that was rolling, that's part of it, but it's really a lot more than that. So even the June contract crashed 30% on the week. So to me, the takeaway is pretty simple. When crude crashes 20% like it did back over here and the market ignores it, that's a major economic signal. Energy prices and economic activity are highly, highly correlated. It took the S&P a month to get the message, but eventually lost 34%. Here's a 5-minute chart of the S&P 500 and the 30-year yield over here. And this is what I was saying in last weekend's video, that yields were reflecting the same ugliness that crude was. they were diverging sharply from the S&P 500. This week, what they do made a lower low and continue to negatively diverge. So the macro signals coming from commodities like crude oil and treasuries looks very ugly, looks very deflationary. It's like the stock market has bought the idea of the economy reopening and a V-shaped recovery, while the bond market and crude are obviously not seeing that. In fact, if we look at the 5-year yield, it actually made an all-time new record low on Tuesday as crude was crashing. So let me show you something real quick. So here we are, March 2009. That was the bottom of the bear market for the S&P 500. Let's pull up the 5-year yield. By March of 2009, they had bottom in December. They were already looking forward to growth. Fast forward to where we are today. Here's the S&P 500 looking for that V-shaped recovery in the economy. And here's the 5-year yield touching a new all-time record low this week. So in my opinion, we have like 2 of 3 macro signals or asset classes sending macro signals. That would be the bond market with treasury yields over here. I've added USO for crude oil in blue over there, and you can see the correlation, the same message being sent by treasuries and by crude oil. And then we have currencies. So currencies to me are still kind of neutral, haven't really taken this turn like crude and rates have. One other thing to mention real quick, high yield credit really didn't act well this week. This is HYG in blue. This huge move up is when the Fed said on April 9th that they would be buying high yield credit or high yield debt, junk debt, and that they'd even buy the ETF. So we saw this huge move, but it's really been surprising to me since junk debt is backstopped by the Fed that it was acting so poorly on a relative basis throughout the week. Coming into the week, it's making a lower high over here, where the S&P is kind of rallying at the end of the week. It is closing near the lows of the week, about where it was when crude was trading at negative prices. We do have a loss of momentum in the averages. We do have some trend breaks in some important sectors, and we have the cyclical sectors that really aren't acting all that well, aren't really participating. Next week, we have the heaviest week for earnings so far. 120 S&P companies are going to be reporting. That includes Facebook, Apple, Amazon, McDonald's, Boeing. Boeing was horrible this week. And then we also have the Fed, or the FOMC, on Wednesday at 2 p.m. But it sure seems to me that as we go into earnings next week and as we go into the Fed meeting on Wednesday, that the S&P just wants to hang around this 50-day moving average. But that said, when you get a 10, 20, 30% drop in crude oil or in copper, that's a really major macro signal that the market is sending you. That's the kind of thing that happened over here, and stocks went to new highs. And because stocks went to new highs, people wrote this off and didn't think it was a big deal. It's the same kind of really ugly macro signal that we got in copper in 2018. Stocks ignored it, went to new highs, and then we had a 20% crash. And obviously that's the same kind of thing that we saw this week, whether it be the May WTI contract that traded negative, or whether it be the June contract that dropped 30%, or whether it be Brent crude that's not landlocked. It's sending the same kind of signal. The bond market's sending the same kind of signal. And quite frankly, the bond market, the commodity market have had a much better track record than the equity market. Okay, so that'll do it for this weekend's video. Thank you very much for watching. If you enjoyed it, please give it a thumbs up. If you have questions or comments, leave them in the comment section below. I'll do my best to answer as many as I can. And check out the website. I post free content there. You can also follow me on Twitter. Thanks again, everybody. Have a fantastic weekend. Stay safe.